Hi everyone, today we will learn about standard costing in Module 8. Before we start, what is standard costing? So standard costing basically is just how you want to calculate your actual estimated cost with your actual cost. So it's substituting your expected cost for an actual cost. I hope you can understand more in the problems. So we will learn that today we will use more about standard costing. Okay, and we are going to use these formulas for this one module, for module 8. And yeah, this is the module, the formula that you need to remember. We have MPV, MUV, LRV, LEC, VOSV, VOEV, FOSV, and you can read it later on. Okay. Next thing, okay, we're going to go into the problem. So in here, problem 8.1, we have that a product of following data that standards per unit for the product is direct materials 28 kilogram with $28 each kilogram, and direct labor 13.5 hours at $9 per hour. And then we have this one is standards. Okay, then we have the actual details with output produced with 10,500. This is the actual also direct materials. Purchase 330,000 kilograms for 8,250,000, and then we have ending inventory with 5,000 kg. Okay, and then we have the direct labor, 85,000 hours, work for 1,275,000, and no work in progress at beginning or end of the period. And then they state that whether the variance is favorable or unfavorable. And then we need to calculate the MPV and MUV, and then LRV and then LEV. Okay, so before I continue, there is favorable and unfavorable. So favorable is when your actual income more than your budgeted income, or your actual expenditure is less than your budget expenditure. Okay, what if it's favorable? What if it's unfavorable? Unfavorable means your actual income is less than what you budget, or your actual expenditure is more than your budget. Okay, so that is the meaning of favorable and unfavorable. Okay, so we'll just continue to the problem 1. So right here we have the calculation already for you. So the first thing is we need to find the MPV. Before we start to MPV, we can see the formula. MPV is actual price minus with standard price times with the actual quantity purchased. Okay, first of all, actual price. We don't have the actual price. We do have actual price for materials, but it's all in bulk. It's 8 million at all. We don't have the price per unit. That's why we need to find the price per unit first. With the actual price, 8,250,000 divided by 330, we get $25 per kg. Okay, so 8 million divided by the 330,000 kg, we get the $25 per kg. And then we can count the MPV. So the actual price for per unit is $25, and then the $28 is came from here, $28 per kg for the standards. Okay. The actual quantity purchase is 330 kg, so 330,000 kg. And then we calculate it, we get minus 990. And minus means favorable. Okay, for this module, to be simple and to be brief, favorable is when it's minus, it's favorable. So when it's plus, it's unfavorable. Okay, minus is favorable and positive is unfavorable. Okay, continue to the second one is the usage variance. So material usage variance, you get the formula of actual quantity used minus standard quantity times with standard price. Okay, so the actual quantity used is we purchased 330 at the beginning. In the end, left 5,000. So how much do we use? And that's why we need to count it, which is the actual quantity used is 330 minus 5,000, and we get 325 kg. Okay, this is the actual quantity used. And then what if the standard quantity? Okay, the standard quantity, they only tell you that it's 28 kg of direct materials. But impossible 28 you compare it with 330. So we need to see that the output produced is 10,500 units. That's why we take the direct materials of 28 kg times with 10,500 units of how much is actually produced. And then we get 94,000 kg for the standard quantity. And then just put it into the formula. 325 minus 294 times with 28 with the standard price. The standard price is from here, direct material standard price. Okay, and we get the MUV is 868,000, and since it's positive, it's unfavorable. Okay, next we have labor rate and efficiency variances. Okay, so for labor rate variance, we have the formula actual rate minus with standard rate times actual hour. So for actual rate, we don't have it because why? They only give us in a bulk 1,085,000. Meanwhile, for the standard, it's stated that it's 13.5 hours. So we need to find first by dividing 1 million with 85,000. So right here, 1 million divide with 85,000 hours, we get 15,000 hours for the actual rate. Okay, and then $15. For the standard rate, it's right here, 13.5 hours with $9 per hour. So $9, right, times with the actual hour. Actual hour is 85,000. So we calculate it, we get it 510,000. And since this is positive, so it's unfavorable. Okay, if it's positive, it's unfavorable. If it's negative, it's favorable. Okay, continue to the next one is LEV, or labor efficiency variance. So the formula is actual hour minus with standard hour times standard rate. Actual hour, we get it already, 85,000 hours. And for the standard hours, we need to find it first, which is 13.5 hours, and the unit that we produced, which is 10,500. Okay, so 13.5 hours times with 10,500 units, we get 141,750 hours. And then we put it into the formula, 85 minus 141 times with $9 with the standard rate, and we get this amount, and it's favorable since it's minus. And we are done for problem 1. So in this module, basically you just need to remember the formula, see how it fits, and yeah, voila, you got it. You got the formula, you got the number, the amount, and you're done. You just need to see either it's favorable or unfavorable. But the thing that you need to be careful is the amount of like actual and standard. It's usually kind of confusing, but yeah, just be careful with the number. That's all. Okay, continue to the next one. We have problem 2. Right here, John Company, they had planned to produce 200,000 units. However, 250,000 units were produced. Okay, they planned 200,000, but they eventually made to 250. And then the company uses direct labor hours to assign overhead to products. And each unit requires 1.3 standard hours of labor for completion, and the fixed overhead rate was $30 per direct labor hour, and the variable overhead rate was $9 per direct labor hour. Okay, and the actual results for the year, so we have actual production in units, it's 250,000 units stated here as well. Actual direct labor hours, 230,000 hours. Actual fixed overhead, 6,500,000. Actual variable overhead, 1,610,000, and it's all in bulk. Okay, so we are right here. Requirement is state whether the variance is favorable or unfavorable, still the same, and then we need to calculate the variable overhead spending and also variable overhead efficiency variance. We get to calculate the fixed overhead spending and also the volume variance. Okay, before we continue, the first one is variable overhead spending. So right here, variable overhead spending variance have the formula of actual variance overhead rate minus the standard VOH rate times with the actual hour. Okay, standard and actual rate. Right here, we have the actual rate. We have the actual variable overhead, but not the rate. Okay, for standard, we have the rate ready, which is variable overhead rate for standard. It's $9. Okay, so basically we need to find the actual VOH rate first because we don't have it, which is 1,610 divided by 230,000 hours. We get $7 per hour. And how do we know? We divide by hour because they told us that the direct labor hours is assigned to overhead. Okay, so we use the direct labor hours. And then we can count $7 minus $9 minus the actual hour, which is $230,000, 230,000 hours, and calculate it, we get $460,000, and it's favorable since it's minus. Okay, $9 we get it from here. Don't forget variable overhead. Okay, next is VOEV, or variable overhead efficiency variance. The formula is actual hour minus with standard hour times the standard FOH rate. So standard FOH rate we got it ready, okay, 9. And then for the actual hour we also get it ready, 230,000 hours. Meanwhile, for standard hours, go back and see that they only give us that each unit requires 1.3 standard hours. So they only tell us about this each unit, and we need to find the total unit one is how much. So basically we take 1.3 times the actual produced one, 250,000 units. Okay, 200. And we get 325,000 hours. So you must be asking, why are we going to use the produce? Why do we use the produce one and not the plan to produce one? Because meanwhile, we are going to find the standard hour, and that is budgeted. Okay, the answer for that is right now we have the actual one ready, but we want to know how much if this budgeted rate is calculated with the actual amount. And that's why we use the actual amount for the units. Okay, and we get, and yeah, after that we get the standard hour, which is 325,000 hours, and calculate it, we get 855,000 minus, so it's favorable. Okay, continue to the next one is fixed overhead spending variance. Fixed overhead spending variance have the formula of actual FOH minus budgeted FOH. As simple as this, actual FOH is stated down here. The actual fixed overhead is $6,500,000. So we get it ready. Meanwhile, for budgeted, we haven't got it, but they told us that the fixed overhead rate is $30 per direct labor hour. So we know that we need to use the direct labor hours to find the budgeted fixed overhead. So how to count? It's basically take the $30 times with 200,000 units, which is the plant produce, and the 1.3 hours, which is the standard hours of labor. And now you'll be asking, why is it 200,000, not 250,000? Because it's stated right here that it's budgeted. But for standard hour, they didn't state that. Okay, they are going to find the budget, but with the budget rate. But for budgeted FOH in this fixed spending, you are going to use the budgeted as in all completed budgeted. Okay, so we got 7,800,000 and we put it there, and then we calculate it, we get 1,300,000 minus 1,300,000, and it's favorable. Okay, continue to the next one is fixed overhead volume variance, or FOVV, with the formula budgeted FOH minus with applied FOH. So budgeted FOH we have counted before, 7,800,000. Okay, for applied FOH is to find how much is the really applied one. Okay, not the actual but the applied one. So we have the formula here, standard FOH rate times with standard hour. So the standard hour is 1.3 times with 250,000 units. We got it right here, 325,000 hours. And the rate is $30. So we just need to calculate it. And we got the amount. We calculate the FOVV. We get this amount, and it's favorable since it's minus. And it's done for problem 2. Problem 8.2. Okay, and we are done to problem 8.2. Continue to problem 8.3. This is more complex. So problem 8.3, at the beginning of year, Yang company had the following standard cost sheet for one of its products. So we have direct materials. This is the standard cost, okay? Standard. Direct labor. Variable overhead. And then fixed overhead, as well as standard cost per unit. So it's the total cost per unit. Okay, and then continue to the problem. They said that the fixed overhead rate is based on practical capacity of 250,000 units. And for the year 2022, the company has produced 160,000 units. So the actual amount that they produce, with the following actual data. Okay, direct material, they purchased 33,000 grams at total cost of 180,000. Okay, ending inventory of direct materials was 2,000 grams, and then the direct labor use is 4,400 hours with $79,200. Variable overhead cost was 70,400. Fixed overhead cost was 65,000. And the requirement is we still need to state whether the variance is favorable or unfavorable. And we need to find the MPV and MUV with assumption that no beginning inventory of direct material, LRV and LEV, VOSV and VOEV, FOSV and FOVV. So it's accumulation of problem 1 and problem 2 basically. Okay, continue to this. We will just continue to the problem. So MPV, we have the formula of this, actual price minus standard price times actual quantity purchased. The same, go back and see the actual price. We still haven't had it because they only give us the bulk amount. So we need to find it by dividing 198 with 33,000 grams. We get $6 per gram, and we get $6 for the actual price. For the standard price, it's stated down here that it's $2.2 per for one material. So one material is 0.4 grams. Okay, so minus 2.2 times the actual quantity purchased, which is 33,000 gram, and we calculate it, we get $125,400, and since it's positive, it's unfavorable. Okay, continue to MUV. MUV has the formula of actual quantity used minus standard quantity times with standard price. And the actual quantity used is, we need to revert back. They have no beginning inventory, so the direct material purchase in the beginning 33,000 is the beginning inventory, and the ending is only 2,000. So at beginning they have 33,000, they purchased 33,000. At the end, only 2,000 was left. So we can assume that the actual quantity used is 33,000 minus 2,000. We get 31,000 gram used. So it's used in the material. So we use 31,000 gram. Meanwhile, for the standard quantity, they didn't tell us also, but they do tell us that one direct material is 0.4. With the unit produced is 160,000. So 0.4 times 160,000 units, we get 64,000 units. And we minus it with 64,000 units, put it in the formula, times with $2.2, which is the standard price. And we get minus $72,600, and it's favorable since it's minus. Okay, continue to problem number, the next problem, which is LRV and also LEV. So LRV and LEV get the formula of actual rate minus standard rate times actual hour. The actual rate is not stated, but they do tell us that the direct labor used for 4,400 hours is 79,200. So we need to calculate it. 79,200 divided by 4,400 hours, and we get $18 per hour. So $18 per hour minus with $23, which is stated here in the data, $23 for the direct labor. Okay, continue, times it with actual hour, which is 4,400 hours, and we get minus 22,000, and it's favorable since it's minus. Continue to LEV. So basically LEV right here is actual hour minus standard hour times with standard rate. The standard rate is found, which is $23. The actual hour is also found, which is 4,400 hours. But for standard hour is not given, so we need to find by 0.1 hours. We get the 0.01 hours from here, 0.01 hours, times it with the total unit produced, which is 160,000 units, and we get 1,600 hours for the standard hours. Put it in the formula and we can calculate them. We get 64,400, and it's unfavorable because it's positive. Continue to the next one is VOSV and VOEV, which is variable overhead spending and efficiency variance. Okay, for spending, we get the formula of actual VOH rate minus standard VOH rate times with actual hour. Okay, so the actual VOH rate is not stated because they only give us the total amount, which is 70,400. Okay, so 70,400, we need to find first dividing the total hours, which is 4,400 hours, and we get $16 per hours. You must be asking, why 4,400? Because 4,400 is the labor used, and if they didn't state the overhead is based on what, you can see right here, it based on hours. They also stated one, it based on hours, so we can know, okay, what is the only thing that is based on hour on this problem? It's labor, so that's why we use labor for this. Okay, and then we can calculate 16 minus with 23. 23 is from the standard FVOH rate, which is this. Okay, and then times it with 4,400 hours, and we get minus $30,800, and it's favorable since it is minus. Continue to the next one. It's VOEV of variable overhead efficiency variance with the formula actual hour minus standard hour times standard VOH rate. If you notice, this is the same as this one. Okay, it's the same one. Why? because they are using the same amount, and the standard VOH rate coincidentally is the same. Direct labor and VOH, they have the same amount, so it's the same. But the variable overhead, if the variable overhead rate right here is different, then they have different amount. Okay, so basically you just need to put it the same one, and we get 64,400, and it's unfavorable, and it's the same as this one because the standard rate is the same. But if the standard rate is different, then you need to recalculate it. Okay. The next one is FOSV and also FOVV. FOSV is for the fixed overhead spending and volume variance, and we get the formula of FOSV is actual FOH minus budgeted overhead FOH. So the actual factory overhead, fixed overhead, is stated that it's 65,000. So we have it here, 65,000. For the budgeted, we need to count it first. So budgeted FOH is basically what we budget. So we get the right here FOH based on practical capacity. So practical, not the actual, is 250,000 units. That's why we put it 250,000 units. And then we go and see the table. Fixed overhead is 0.1 hours times $27. So we put it in 0.01 hours with $27, and we get $67,500. So we put it in 67,500, and we get minus $2,500, and it's favorable since it's minus. Okay, next one is FOVV. We have the formula of budgeted FOH minus applied FOH. So budgeted FOH is counted before, and we get it. But for applied FOH, we haven't found it. So applied FOH have the formula of standard FOH rate times with standard hour. So the standard FOH rate and hours is still the same as this, but the amount of 160,000, the unit is different. Why? Because the applied one, we want to see how much is actually for the applied using the standard costing. Okay, so we have produced 160,000 units. That's why we calculate it, we get 43,200. And we just put it in the formula, and we get 24,300, and it's unfavorable since it's positive. And we're done with problem 3 and module 8. So thank you for today, and I'll see you in the next module.